Welcome to the Retire with Peace podcast, the podcast where we help you create a fulfilling and stress-free retirement. Each week, we bring you expert advice, practical tips, and inspiring stories to help you plan and live your best retirement life. Whether you're nearing retirement or already enjoying your golden years, this podcast is here to support you every step of the way. Let's embark on this journey together and discover how to retire with peace.
Welcome back to the Retire with Peace podcast. As always, I'm your host, Dave Zaegel. The Federal Reserve, they've been in the news a lot lately. There's a lot of drama between the president and the Federal Reserve. If you hadn't heard about it, don't worry about it, really. But there's just been a lot of drama back and forth. It's not unusual that there's drama, but usually there's not criminal indictments. So it's been a bit different this time around. So I thought this would be a timely topic to talk about what the Federal Reserve is and why it matters for retirement planning. This is not intended to be a full history of the Federal Reserve and all the ups and downs and backs and forths and the detailed analysis of what it can do. But we're going to talk about what they have the ability to do and what their role is, and transition that into why does it matter for investing and retirement planning. The Federal Reserve has a dual mandate. One is to control inflation, and the other is to maximize employment. Those are two very different things. It's often tough to try to manage both. Because again, they're so different. Inflation and employment, there's some tied together for sure, but they can be very, very different. And oftentimes, the Federal Reserve only has very blunt instruments to try to combat inflation or try to increase employment, reduce unemployment. So they'll set different target rates of inflation, target rates of unemployment, and they'll try to use the tools that they have to manipulate the economy to get it where it needs to be. But there's a lot of factors that are way outside of the Federal Reserve's control. They're trying to manage the ship while storms are rolling in. Sometimes it's calm waters, sometimes it's stormy waters, and they're trying to manage this boat as best they can, because it's going to depend on macroeconomic factors like household formation, what Congress is doing, because that can have a big impact on the economy as well. So oftentimes the Federal Reserve's trying to battle a lot of these forces to get what it wants, which is two wildly different things of inflation under control and maximum employment. One of the misunderstandings is that the Federal Reserve does not control all interest rates. The Federal Reserve really controls the very short-term interest rates. They more specifically can control the overnight lending rates between banks. There's other things they can do in terms of providing liquidity. We're not going to get into those details, but just in general, understand that they do not control all interest rates. They can control the short-term rate. And that is the rate, when you hear about them raising or lowering interest rates, that's the rate that everybody's talking about. It's the short-term borrowing rates. The long-term borrowing rates, especially think 10, 20, 30 years, the Federal Reserve can influence those indirectly, but they do not control that. There is an entire market of bond trading that is wildly larger than even the stock market. Everybody thinks that the stock market is the big deal, and it is a big deal, but the bond market is much larger. So there's this whole entire market of bond trading that really controls those longer term interest rates. The Federal Reserve can have some influence because they have the ability to buy or sell treasuries, mortgage-backed securities, things like that. So they can have a hand in that buying and selling of bonds in that market, but they do not control the long-term interest rates. And that's just an important distinction, because there have been many times in the past where the Federal Reserve, let's say they've tried to bring interest rates down, and so they've lowered that short-term interest rate, but the long-term rate remains stubbornly higher. In some cases, actually went higher. So it's just important to note that even if you get what you want or don't want on the short-term rates, the long-term rates aren't necessarily going to follow. And we've seen that in both directions. We've seen the Federal Reserve trying to raise rates, and the long-term rates just won't go up. And we've seen them push the short-term rates down, and the long-term rates just won't quite go down. They do not have control over that long-term rate. And those longer-term rates, especially the 10-year Treasury, are what controls things like mortgage rates and a lot of other things that are set based on more long-term lending, mortgages being the most obvious one. So the short-term rate, the Federal Reserve can control that, and that's fine. Long-term rates, not so much, although they do have some influence. So it's important to lay that foundation of exactly what the Federal Reserve is trying to do with the dual mandate of controlling inflation and maximizing employment, and the relatively blunt instruments they have of managing short-term interest rates and then having the ability to provide some money supply and also buy and sell longer-term treasuries and mortgage-backed securities. Now, why does this all matter when we talk about investments and retirement planning? Well, interest rates really matter because when you think about investing in stocks and bonds, there's a couple of pieces where interest rates come in play. Let's talk about bonds first. Those of you who have listened to this podcast know that when we work with clients, we tend to use individual bonds versus bond funds, because bond funds they'll change value up and down based on changes in interest rates. That can be fine. That can actually go in your favor. As interest rates are coming down, those bond funds will actually tend to become more valuable. As interest rates go up, like we saw in 2022, those bond funds will decrease in value, and they had a rough year that year for that reason. So those bond funds will fluctuate over time, and they have that interest rate risk. We prefer to use individual bonds with set maturities, because even though those bonds will still fluctuate in value, we are holding the bond to maturity, and we know exactly what the value will be when that bond ends. And we line up these bond maturities with when clients will need the income. So that removes that interest rate risk. So whatever the Federal Reserve does or whatever the bond market does with interest rates, we don't have to worry about that at all when we're using individual bonds and letting them mature. Now, that will certainly impact the bonds that we are able to buy and what those interest rates are, but that's not going to be a massive impact on our planning. It's just more important that we have a reduced number of risks and reduced amount of risk from the bonds that we are holding over time for clients that will need income in those years. So you have the interest rate impact on bonds, but then it also can impact stocks, because stocks and bonds can really be alternatives for each other. So if you think about a U.S. Treasury or a AAA rated corporate bond, there is assumed to be little to no risk of you not getting your money back on that bond. Now we can talk about how the U.S. is looking in terms of its own financials and will you get your money back? The answer is probably yes, because they can print money. But the whole point is, if you're AAA rated or you're really highly rated, there's almost no risk of you not getting your money back on that bond. So that's called a risk-free rate of return. As that interest rate rises, stocks, in theory, become less attractive because there's risk associated with stocks, versus that risk-free rate of return. If that's going higher, all of a sudden that looks more attractive, because now you can get more money with a whole lot less risk as these interest rates start to rise. And conversely, as interest rates start to fall, you're not getting paid out as much on bonds, even though they're theoretically less risky, especially for the high quality bonds. And so with that interest rate going down, the value of stocks starts to go up, because you're taking more risk in the stocks, but you're getting paid more over time in terms of rate of return. So that's why we see interest rates, they do have an impact on the stock market. It's not necessarily that it's going to tank the stock market if interest rates, long-term rates, go from 4 to 4.5 or something like that. They might have some short-term impact, and they might impact dividend stocks more than others. There's a wide variety of impacts that it can have. But just understand that when you hear about people worrying about interest rates and what it's going to do to the stock market and bond market and all this stuff, they absolutely do have an impact. How much? That's debatable. The key to all this is to plan accordingly. Have these individual bonds for income focus on the long-term growth for stocks. That way, no matter what's happening with interest rates, unless it's something extremely crazy, you know that you're set from a planning perspective long term. But now you can understand what the Federal Reserve is doing, or at least trying to do, and what they have control over and what they don't.